I was muted. My bad. Hello, everyone. Thanks for tuning in. Let me start over because I've been speaking for like a minute. So thanks a lot for you guys for tuning in on the Zoom link. Thanks for you guys on YouTube on the YouTube live stream who've been waiting. I like to do the session every now and then to talk a little bit about fundraising strategy. I think that I always say that fundraising sucks, and the reason why it sucked for me when I went through Slidebean's funding rounds was because I don't think I really understood, round structure or when you're supposed to raise one round or the other. So I wasted all this time and effort trying to raise money at the wrong time. And I think that the rules, if there are any rules as to when you should try to raise money, are much clearer now. And I think that a lot of people don't know what those rules or those standards are. And that's why I do the session. So let me share my screen and get on with it. I have about 30 minutes worth of slides. We normally in this session we have a bunch of time for questions. So let's see if let's hope that works. And let's hope that the screen share thing works. Okay, cool. So again, thank you for tuning in. I got to check if this is working. Sorry, I don't really have like an iPad thing here, but okay, cool. Okay, so hello everyone again. A lot of people will say that that I'm Slidebean and that's some sort of nickname. It's not. I actually run a company. We were a venture-backed tech company. We have a software platform for fundraising. And my name is Caya. I'm one of the founders. Just to get that out of the way. And we've been helping founders, or Slidebean has been helping founders fundraise or kind of navigate this stuff for it's going to be 13 years now. And we're not just a YouTube channel, by the way. And like I said, raising money sucks, or at least it was a really shitty experience for me. But let me try to help and let me try to be useful, clarifying some of this stuff. So let's first think of funding, right? I think funding becomes this painful process for a lot of founders because we often see funding as sort of the end game, right? We have to, like, I built a product just to fundraise, right? We've been founders will spend months kind of writing pitch decks and doing iterations of those pitch decks and talking to investors, right? So it starts to feel like funding is really the end goal, when in reality is just a means to an end, right? And the end game for any startup, for any company, should absolutely be one of these two things. The end game should either be selling the company or doing an IPO. So okay, am I missing one? Am I missing one of those here? Shouldn't profit be the end game of starting a company? Well, not always, and let me explain why. So let me give you a typical example, right? So many of you guys may be thinking, hey, I need something like $1 million funding, right, to start this business. And that's not crazy. Like in 2025, the average pre-seed round, I'll talk about what a pre-seed round is in a second. The average pre-seed round ended up being like $900,000. I think that was median or the average. I'm not sure. But it's not a crazy number either way. And a lot of you guys might be thinking, okay, I'm feeling like I want to give investors something like 15% of the company, right? I don't want to give them 50% or I want to retain majority, right? What's the 51% Hollywood thing, right? So I want to be owner of this company. So yeah, you might be feeling like something like a 15% share to investors. Okay, so let's see how that looks like. Investors get 15% of this company. Great. So let's say that the company does well, right? And it grows to, say, making $10 million in annual revenue, annual run rate if it's a SaaS, or annual revenue, which is no small feat, right? A $10 million business is no small company. Okay, great. So how do investors get their investment back in this hypothetical $1 million 15% round? Well, a typical company, right? A typical company will operate in an EBITDA margin, that's earnings before interest, taxes, depreciation, amortization, net profit basically for taxes. Will operate on EBITDA of 10%. That's not a crazy weird number. Some go to 15, some go to 5, some go to 0, but let's say 15. Okay, in that case, I'm sorry, 10, 10. Let's say that that company makes 10% in EBITDA, and then they have to pay taxes on that, right? So at least federal income tax in the US. So that's going to be about 21% plus city taxes and other, but at least 20% of that will go to taxes. So you're going to end up with 8% of that after taxes. Ballpark. Okay, so this company made 10 million, right? And now it's down to 800,000 in true net profits. After just, again, typical expenses, company costs, team staffing, rent, etc., taxes. Okay, good. So what happens now? Well, now that we have this dividend, right? This $800,000 profit, like true net profit, we have to, we can, we don't have to, the founders don't have to, the board doesn't have to, but we may want to share that with our shareholders, right? Split it. Okay, and what would happen is, well, investors, as they own 15% of the company, they would get 15% of the pie, right? So 15% of the $800,000 profit. So that's about 120,000. Great. Which sounds like a lot of money, but let's remember these guys invested $1 million. So assuming this company has reached $10 million in revenue, assuming it operates profitably on a typical 10%, assuming it makes those 800,000, and now the 15% that goes to investors is 120, which basically means that it's going to take us like 9 years for these guys to make their money back just once, right? This is just like a one-time payback, just recouping this money. If the company survives, if the company does well, if everything matches, and if the board decides to pay dividends, because the board might decide not to pay dividends. So that's not a great deal, is it? Where's the ROI, right? Like why, like when are these investors going to make any money from this company? Especially considering that there's risk, right? We haven't accounted for the risk of starting a company, or the company failing or a competitor coming in, right? So that's not a great deal. I'm not an investor, but if I were, I would not take this deal. And that's kind of like, I think, a mindset that a lot of founders have. It's like, oh, yeah, I'm going to raise $1 million to build a $10 million company. And they're not thinking about this breakdown of like how little of a percent actually goes to the investors that funded the business. Okay. So let's look at another scenario, a better scenario that's more typical to what a round usually looks like. Okay, in a better scenario, let's think of the same idea, right? It's $1 million funding round. Investors are getting 15. So let's assume that instead of focusing on profits, this company focuses on growth. Not profits, but really fast growth. And in order to do that, because the company is not profitable, they're going to need more investors, right? So more investors might come in. They're going to dilute the original investors. So the original 12, the original 15 might become 12 or less, even as more investors kind of eat up on that pie. But because this company is really, really focused on fast skyrocket growth, it's not gonna rest at $10 million in revenue. It's gonna get to $50 million in annual revenue. It's not profitable. But it gets to 50 because it's just like really, really reinvesting every dime back into the company, into a better product, into marketing, into growth, right? So it hits 50 million in revenue, not profitable. Okay, what happens now? Well, again, it's not that we now turn profitable. It's not that we lay off half the staff. It's that instead of seeking profits, the company looks for an exit, right? And the company is looking for a bigger company to buy it up, maybe because they are a competitor to them and they want to just remove a competitor. Maybe it's a partner and they want to join forces. They think whatever that it becomes of these two companies together might be better than the sum of its parts. For whatever reason, company gets acquired. But when a company gets acquired, because there's this interest in buying the company, the buyer tends to pay really good multipliers. Buyers, even today in this day and age, or more so today, are willing generally to pay something like 5 times revenue. That's not a crazy valuation, 5x revenue. So this company that didn't make any profits ever, because they have valuable technology, because they have valuable IP or valuable customer bases, or some of all those three, gets bought for 5 times revenue, so a $250 million buyout. In that case, investors would get, well, 12% of that buyout. That's a $30 million check for these investors. And if you even apply the 12% thing, that's still a 30x ROI, $30 million in return for a $1 million investment. That is the game of venture capital. 30x ROI in 7 years. That's the game that venture capital investors are playing. And founders often forget about this. I think founders often think of like, hey, like the dream of building a business or the dream of running that business, and kind of not like making it a family business and then inheriting it to your kids and so on, which is great. And that's a very valid way to build a business. Not with investors though, because investors need that ROI faster. Okay, so 30x ROI in 7 years. Some caveats here. This is obviously super risky. You need to be growing really, really fast to accomplish that in just 7 years, not in 20. You're probably not going to be profitable ever. You're going to need more investors to fund this. And again, the end game of this is an exit or an IPO. That's the only way you get this back. It's you don't get it back with profits ever, right? So that's a big difference. And hopefully at least that justifies a little bit why like profit is normally like a red flag word when pitching investors, because if you're focused on profits, then you're not focused on growth. And if you're not focused on growth, then ROI gets tough for the investors. Okay. So we established that funding is really just a means to an end. And because we're not going to be profitable for a while, if we're in venture capital, we're going to need to go through all these long, multiple rounds of funding, right? All the way until that very end. And we've actually not we as Slidebean, but we, the startup people, we've standardized a little bit, I think, what those rounds look like and what those rounds mean and when you're supposed to raise each one of those rounds. So let's talk about those. Now, one common mistake founders make is think that seed rounds happen kind of like here, right? Oh shit, let me move my face. Yeah, so like this is a common misconception, thinking that you launch and then you raise a seed round. And I see this a lot, right? You see a group of founders that bootstrapped, like use their savings, their life savings to build this product. They finish it, and now they don't have any money to market it, and that's when they go to investors to raise money. That's a really shitty time to try and pitch an investor, because you don't have any leverage against them, right? And in the end, a lot of the way venture capital or funding rounds operate is with a FOMO factor, fear of missing out, right? Like you want investors to see this company and feel like if they don't put their money in now, they're going to miss this great opportunity to make a shit ton of money. Right? Like you want to create this FOMO. And when you have a product that's ready, that you maybe launched or ready to launch, and you haven't gotten any customers, you don't have any leverage, because it's like, well, as an investor, I can just wait. I can sit down and wait, right? I can grab a coffee, wait for a month and see what happens with this product, because I'd rather, see this team, see their capacity to deliver, see their capacity to get customers, etc. And at the same time, you're in this catch-22 because you spent all your money to build this product and you don't have any money to market or to grow or to sell this product. So that's a really, really bad position to raise money. You don't want to raise money then. And that's not when seed rounds tend to happen. Actually, seed rounds tend to happen when a company has launched and has something in the $20,000 in monthly revenue. I would say that's typical. I was at the A16Z, Andreessen Horowitz demo day about a month ago, and I saw companies raising seed rounds that had almost $1 million in run rate. So what, 80,000 in monthly revenue. The exception, the majority were, I think, in the $30,000-$40,000 in monthly revenue as they were getting on stage to pitch, but they were pitching seed rounds. And that's what a typical seed stage company looks like, right? Before that means that you launch earlier, right? That means that you launched a few months ago, or at least a few weeks, but probably a few months ago, before you hit seed. So launch actually happens between pre-seed and seed, and that's the point of where it's going. And then for Series A, typical Series A rounds happen at $2 million in annual run rate at least. So that's what, 160,000 in monthly revenue for a typical SaaS and so on. If you're a marketplace, where where you have a new metric that's GMV, gross merchandise value, and all the transactions happening in your platform, I don't think that $2 million worth of transactions is enough, because that would only translate to what, $200,000 in revenue for you. So for marketplaces, that's probably a little bigger. a much bigger chunk of revenue. Well, not revenue, but GMV by the time you raise Series A. Now there's another type of company here, which is what I like to call the R&D or the hardware company. I get this question a lot. I've never built a hardware company, so I don't know as much about them, but I've worked with a few. And yeah, like rounds for hardware or for like what I could call R&D tech companies are a little different. I have a good friend that's running a biotech company. They're trying to develop a cure for cancer, and they have to raise hundreds of millions of dollars just to go through clinical trials. So it's a very different game where milestones exist for seed and pre-seed and so on, but those milestones are not based on revenue, but they're mostly based on on just milestones of development or patents issued and stuff like that. For like deep tech, like even like deep software, if you're building, I don't know, like OpenAI would be I guess a bad example, but if you're building your own LLM or your own new AI technology from scratch, then yeah, there's a good chance that you won't be able to launch at pre-seed. But if you're just plugging, if you're just plugging technology that already exists, if you're vibe coding, like most companies, I'd say 90% of companies that get started can just operate by our standard, right? Pre-seed, seed, Series A. So let me talk a little bit about what each of those rounds means, what typical milestones you need to have hit to raise each one of those rounds. And again, that's to me the biggest mistake I've made when trying to raise is I was trying to raise a pre-seed before we had the milestones, and I was trying to raise a seed before we had the milestones. So it became a really painful process of getting a lot of rejections and spending a lot of money just traveling and meeting people. This is pre-COVID, where face-to-face was more valuable. It still is, but so like I wasted a lot of time, which sucked. I think the other factor that people overlook, sorry, with funding rounds is that they will take all of the founders' time. Like doing this fundraising takes for at least 2 to 3 months, all of the founders' time. Typical round will take about 6 months to close from the moment you start pitching investors to the moment you get money in the bank. You should count about 6 months. And at least for the first 3 months, the founder or the CEO, whoever's doing the round, normally the CEO, will be out. Like that person will 100% of the time, or like 95% of the time, will go to raising the round. And so the typical the problem with those cases is that if the company needs to run without you, the rest of your co-founders need to run the company and keep it growing so that it shows good metrics so that you can go and raise the round. That's one of the big problems with solo founders, that if you're on your own and you're fundraising, then who's running the business, right? So the business needs to run while you do this. But let's look at pre-seed. I see a question, Ex Arcadia. What if you're in the games entertainment business where your revenue is centered around a product launch and sales? Same idea, right? And this is kind of a little bit of what I'm talking about here. So, what's a typical pre-seed round here, right? What's a typical milestones for a pre-seed round? So normally a pre-seed round, you will want to raise when you have a fully formed team. You will want to raise it when your founders have all the core skills to build this business. I'll use your example, X Arcadia. If you're a gaming company, you should have marketing, you should have product development, you should have gaming, gamification, product design, etc. Like all those skills need to be part of the founding team, because at the early stage, you're not going to be able to recruit anybody. So you're going to have to do with the founders, with the people who are already part of your team. And yeah, who are like probably very poorly paid or not paid at all because they're operating on their equity, right? And the fact that they're co-founders. And some idea of how you're going to get your first 100 customers. That's all you need for a pre-seed, right? You don't need a product ready. I do believe that you need a little bit of a product progress, right? Just proving that you guys can build this, but you don't need a full product. That's kind of what I'm saying. You don't need a product that's ready. I don't even want to say an MVP. You just need like to prove that you guys can code and the product is in progress and that you have some mockups or UX design and stuff. Like coding is getting increasingly easier now with AI. So like you need to have something to show for. It's not that hard and it's not that expensive to have something to show for, but it doesn't need to be a finished product. That's kind of the point. Because why? Because what you're raising pre-seed to get to seed, right? So the money that you raise needs to get you to seed. So what's seed, right? So we said that seed is a product in the market. Seed is at least $20,000 in monthly revenue. Seed is growth, right? You need to be, it's not just getting to 10K or 20K or 40K in revenue. It's getting to that really fast, right? It's getting to that on a consistent 15, 20% monthly growth. I think 10 is even small. So 20% monthly growth. So you're growing really fast. And this is FOMO, right? If you see a company that's making 40K a month, they just launched a couple months ago. They were growing 20% month over month. They have a cool product. They understand the growth metrics. That's exciting. I want to get into that business before it grows faster and the valuation is not as exciting as it is now, right? That's kind of like the sentiment that you want to create with investors. So red flags or deal breakers that wouldn't allow you to raise a pre-seed. You're trying to recruit the last co-founder. Super red flag. If you don't have a tech co-founder, you can't raise money. I think that's a reality. You have no clue on how to get customers. Again, a lot of founders delay that discussion, brainstorm conversation on how they're going to get customers. But if you're raising a pre-seed, part of your round, a good chunk of your round is going to go to getting those customers because you need to get to seed, right? So it's not just about product building. I see pitches on pre-seed that are all about how they're going to build a product and product development and launch pipeline, not launch, but production, and no thought on how they're going to grow, which is a deal breaker because, again, part of that money is going to go to growth. And yeah, again, budget only lasting through launch. If you tell an investor, hey, I'm raising a pre-seed to finish this product, and then we'll raise another round to launch it, I think that's a deal breaker because no one's going to give you money at that stage. That's like the worst catch-22 stage where you can be at. Okay, so let's do another one. Let's do the next phase, right? So you got to seed, you're raising a seed round, right? You have these metrics. You need these metrics you need the money that you raise to be enough to get to Series A, right? So what's Series A? Typical Series A is going to be obviously revenue, right? So in this case, about 2 million in annual run rate for SaaS. I think that's still a good standard. Could be a little more these days as rounds are getting bigger. You want to see traits of product market fit. You want to see low churn. You want to see happy customers, good NPS scores, good retention. You might have a really good understanding of metrics. The founding team, sorry, my bad. The founding team needs to have a really good understanding of metrics. I've seen a lot of Series A rounds where the founders don't really understand how the growth happened. They kind of got lucky a little bit, but at this point, it's not about getting lucky, right? It's about really understanding what's happening. And there's a good team, and you've started to delegate tasks. I think that's another overlooked flag. Like when the team is too dependent on the founders, and there's nobody else that owns stuff in the company. I think that tends to be a bit of a flag too. Deal breakers that wouldn't let you raise a seed round. You have a product launch, but no revenue. You're raising money for a certain amount of months of runway, but not money to reach Series A. That happened to us, by the way. That's our biggest mistake, if you will. In Slidebean, we raised money for 18 months of runway because that's what investors told us to do, raise for 18 months. But we didn't raise for getting to Series A. We just raised on months of runway, and we stretched the cash to last for 18 months. But by the time we were trying to raise Series A, we only had about $1 million in annual run rate, which is not enough. You don't have the metrics yet. So yeah. As your question, Pigeon, on approaching investors, I'm going to talk a little bit about that in a sec. So I'll get back to this. Okay, let me do just the last one, right? So if you're a Series A and you're raising money to get to Series B, what's Series B? I want to say Series B is probably 5 million in ARR, probably more these days. I want to say like maybe 5 to 10. Series B, you need to have a senior exec team already hired, and you need to have early traits of an exit. So again, if you're raising a Series A, right, you need to budget enough money to accomplish these things. Meaning during Series A, you're probably going to hire your first real executive team from people that come from other large companies, right? That's when that happens. Again, you need to understand metrics really well, and you need to kind of find pathways. Like by Series B, you should have decided if you're on a path to going public or if you're in a path to an exit. And if it's the exit path, you probably should have some early relationships with those potential buyers for those buyouts. Deal breakers for us for Series A, like again, what happened to us, not enough revenue, right? We tried to raise Series A with $1 million ARR, but you need 2 or more. you run out of money before reaching the milestone. You see this a lot with post-seed rounds. A post-seed round is always bad news. If you read any if you read from anyone that they raised a post-seed round, that means that they run out of money before getting to Series A, and they had to raise a little bridge just to get there. And then the other one is just no understanding of growth metrics. Like I said, I worked with more than a few Series A companies on writing their pitch decks that they just don't understand the metrics. They just don't understand growth. They've I don't know, they hire a marketing agency that's been running their ads, but they don't understand what their real cost of acquisition is. They don't understand what their real channels are. At that point, as we go from the alphabet rounds, like rounds become not so much about the product, but much more about the numbers. And the rounds at that point are very much a sort of like a financial model exercise where it's like, hey, like if you give me like these are large rounds. If you give me $15 million for this round, I plug them into this financial model. Look what's going to happen on the other end. And the variables or the knobs of that financial model are facts, right? Our historical performance, right? So it's just it becomes much more a math operation at that point than a founder excitement or a product excitement factor, right? And that's it. I think it's easier because if you have the metrics, then it's easier to raise that money. It's easier to get people excited. Where you need more kind of founder personality or hype, founder hype is earlier because that's all you have, right? You have the metrics to show for. Okay, that's a quick overview of rounds. I always like to leave at least half an hour for questions. So I have about half an hour today. I want to say like 20 minutes. But first, a couple of commercials. Like, by the way, like this, we're hosting this on our live Slidebean channel. But we start live on our YouTube channel. But we have another news channel called the Startup Club, where we do like much deeper dive videos on how to calculate CAC or how to calculate LTV, like really technical startup stuff, rounds of funding, how cap table works, all that stuff. So you should follow that channel. There's a budgeting webinar, not tomorrow, that's my bad. Not tomorrow, but next week. We'll announce it everywhere. But yeah, like if you want deeper dives like this one, you should check our Startup Club channel out. That's where most of that stuff gets published. Our Slidebean channel is it's much more focused on broader stories these days. For you guys on the Zoom link, also like that same place where you found this webinar, you're going to find the new one. And again, last commercial, again, we're not just a YouTube channel. We help founders navigate fundraising. Our platform has a pitch deck builder, an AI pitch deck builder, an investor finder. We have a cap table tool. We have a financial model tool. And one of our subscriptions, our accelerated plan, includes monthly one-on-one sessions with our team, including myself. So, one monthly session with our pitch deck team to review your deck and your slides and advise on that. One monthly session with our financials team to look into your financial model and your forecasting and budgeting your rounds. And last but not least, a strategy call with me as you sign up for Slidebean, and then as you finish the pitch deck and all that stuff, I do another session with everybody just to try and get stuff ready, like a one-on-one session to kind of get ready for investors. So my team is pasting links there to our Accelerate plan. You can just snatch the QR code, and that's all I have. Let's just jump to questions. I see some have come up, so don't be shy. Throw them in. You guys on YouTube have like a bit of a delay, like a 20-second delay from the Zoom guys. So just hurry up with those questions so we don't miss them out. Okay. I see Q&A here. Okay, so Matthew from Zoom. I'm raising for a food retail product. When we will open a store, do the same guidelines apply? Depends. I think it depends. I think that a lot of this applies to tech companies. When you're building more, I want to say air quotes, traditional businesses, the sort of like the type of investor is a little different. Where, for example, if you're a CPG product or if you're a store, like a single store, right? You're not building a product for $1 billion market, right? You're building one store. So at that point, valuations tend to be lower, which means that the money that you raise usually requires a bigger percentage of equity. Not all the rules apply because, at pre-seed, let's say the equivalent of pre-seed, you would need to raise a little bit of money just to open the store. But yeah, that investor will probably require a much bigger chunk of the company. The typical, I don't know I don't know what type of store it is, but a restaurant, like think of a restaurant, like how does a restaurant usually start? You have a money founder and a chef. right? And they usually go 50-50, and the capital partner provides the capital, open, funds the business through starting, and then the chef is kind of providing the operational side and obviously the food. So it's a 50-50 split in those cases. It's not a 15%. So I'd say that those rules don't necessarily apply. Usually. Sorry, a bunch of questions. I got them. Okay, so let me do one Zoom, one YouTube. Pigeon had any advice on cold approaching local regional VCs? What not to do in most cases? I'd say cold emails are usually the worst approach to VCs. You normally want to do warm intros. So you normally want to exhaust every network connection that you have to try and get into those meetings. A good example is Andreessen, like A16Z, one of the largest VC firms in the US. They don't have a contact form on their website. They don't have any contact information. There's nothing. There's no phone. There's no email. There's nothing. So how do you pitch A16Z? Well, you get an intro, right? That's the way you do it. It's true. Their website doesn't have any contact info. So what you do is you try to navigate your network on LinkedIn. You try to find somebody that works at A16Z and a founder, and that founder is kind of like a bridge or they're kind of vouching for you. So a lot of this honestly works on relationships. You see repeat founders tend to raise larger rounds and tend to raise money easier. And it's a little bit because of the experience, but it's mostly because of the network, because they just have a place to start and they're just reaching out to people that already know them and can vouch for them. So if you're a first-time founder, I was a first-time founder, and if you don't have any reputation, then you have to kind of build that, and that takes longer and it's more expensive. I'd say that accelerators are a good bridge to that if you don't have a network, but most people do. I think that most people do. It's just that you have to exhaust that resource, and that's just a homework of going and you can use our investor finder for that. We have like 25,000 investors in our database. So what you do is you filter those investors by what your target, you can, in our platform, you can filter them by industry, by round size, by region. And then you go on LinkedIn and try to find connections to those investors. We actually give you their LinkedIn profile, so you do that. That's the way I would do it rather than cold emailing. Cold emailing doesn't usually work. Okay, Edgar, question: in what stage do Y Combinator and 500 Starters invest? Great question. It's somewhere after pre-seed, I think. Before seed, for sure. Right? Normally at demo days, both YC and 500, they're trying to have the companies be at seed stage by demo day, right? That's the game. So if you just launched a product but have no revenue, I would expect those guys that might accept you, or you're just about to launch. I think that that's a good time to apply. Why? Because in 4 months, those 3-4 months that these programs last, you can go from zero to that $40,000 in MRR and then pitch at demo day as a seed company. That's ideal. I think that if I don't think I want to, I went through 500 startups. I went through Dream Adventures, 2 accelerators. I don't think I would have to do it again. To me, the biggest value of an accelerator is the network. And I think I want to believe that I already have one. But if I were to go again, I would go with a product launched, just launched, but a product in the market that I can use the accelerator and the accelerator money to grow faster and present myself as a seed company. Yeah, I'd say so. Okay, next one. Let's see. How big do you have to be an IPO? I only hear about exits and only massive IPOs like Roblox or Unity, but penny stocks are a real thing, for example. Yeah, like just ignore the whole penny stocks thing. Like nobody wants to be nobody gets into tech startups to be a penny stock. I know that they exist, and I've watched The Wolf of Wall Street, but no. I think that it's usually a really large enterprise, and you look at OpenAI, right? They're a $500 billion unicorn, and the reason they're a unicorn is because they're still a private company. So tech companies can get to tens of billions of dollars in size before they go public, usually. So yeah, bigger than that. Now, interestingly, time to unicorn. We made a video about that, by the way, on the Startup Club channel. My team can paste the link, Josh, if you can help me find it. I think it's the last video we published. Time to unicorn is now like 3 years. A bit of a bubbly behavior with AI, but yeah, like the average unicorn now goes from 0 to $2 billion valuation in 2-3 years, which is mad. But yeah, I at that point still you don't want to go public yet. You're still operating in private money. Okay, Ugo, is it best to raise pre-revenue or after begin? Is it better to raise pre-revenue or after beginning revenue, smaller amount to be desired? I mean, the pre-seed round, pre-seed rounds aren't great in the sense that you have to raise money in just a dream, right? Ideally, and I've seen this happen where a group of founders either has the capital, maybe they had an exit before, or maybe they have savings, whatever, and they skip pre-seed. They just work on this product on their own. They skip pre-seed. They invest a little bit of their own cash into the company and get to seed stage with revenue, with that 40K in revenue milestone, bootstrapped, right? And then they raise money, which is great. They essentially skipped a round, which gives them a much better valuation. They retain an extra good chunk of the company because they did that, but you can only do that if you have the money to do it, right? If you can bootstrap and get to 40K in monthly revenue on your own without external capital, do it. But if you can't, if you're going to get stuck at launch, then it's better to raise pre-revenue. That's kind of the point. Okay, let's see. Do you advise companies on a success fee basis? What do you think about using advisory firms to help with fundraising? That's a great question. I always like it when people ask that. I normally think that fundraising advisory firms are a bit shady. And there's a big line that we draw in the services that we do and the stuff that we do at Slidebean, which is we help you prepare your pitch deck and we help you prepare your financial model and budget. Then we teach you how to do that. And that's where our buck stops. I think that any company or consultant or whatever that charges you money to raise money for you is a bit shady. Why? Why? Because people offered this to me when we were raising money, and every person that offered that to me was kind of shady. I remember that. I also think that fundraising is a founder's job by all means, right? It's you. It's a grinding. It's a founder grinding. Founder calling people, founder getting intros, founder doing network, founder pitching, founder following up with investors. Like it's all founder work, honestly. And there's little, I think, that an advisor or a firm or someone you hire would do there, other than just answer the occasional question on like what equity structure works best and whatnot, which is something I can answer on an email. And so that we as a company, we kind of set that rule. We don't, it's very murky to offer anything in that stage, I think. And so we don't do anything at all in that phase of fundraising. I think founders are on their own. They should be on their own. So like our buck stops at just prepping documents and making sure that your pitch is solid and your financials are solid. But after that, we don't charge or do any services in that phase very intentionally. I have more. How about a startup like logistics, security, tech company? Imran, I'm not sure I understand your question. Do you want to elaborate a bit, maybe? Avocado, thanks for the thing, Avocado. We don't usually do like the super stickers, but thanks. We don't usually get these, sorry, is what I meant. Thanks. So I have an AI company that is currently proof of concept. It brings money, but the key is having a huge building. The concept is successful. I have very senior execs signed on to help. Thoughts? Man, I don't know if I understand the question. I would need to raise several million. Yeah, I don't know if I understand the question. Is it a tech company? I guess it's question one, right? Everything I've said very much applies to tech companies. If you're not a tech company, and just to kind of make that division, an agency, a marketing agency that runs digital ads, that's not a tech company. It's a company that works with tech, but it's not a tech company. Dev shop, it's not a tech company, right? They're not building a product. What I mean by a tech company is somebody that's building a product that scales on their own, etc. So ask yourself if you're a tech company, if you have if there's a billion-dollar market opportunity, because those rules, those two scenarios I walk you through, where company scales really fast, $50 million gets acquired, etc. Normally, those are opportunities for companies that that have some form of, or like that are really deeply integrated into tech. 99% of those companies today, 2025, are AI based, and that's just what it is. So yeah, I mean, if it's a tech company, then sounds like it, but I probably need more context to answer your question. I see you, Mohammed, on Zoom. I once heard first family and friends, then fools to fundraising. That's true. That's true. The triple F is what we call it. Like the founder, family, friends, and fools are your first money in. Normally, pre-seed rounds are raised by them, and it's not. And people misinterpret this as, hey, like go raise money from your family. No, no, no. It's go raise money from people that know you. Because at pre-seed, people invest in companies not because they believe in your product, but because they believe in you. The product might change, the angle of the company might change, the audience, the target might change, but they're investing in you rather than in the product, because that's too early. And that's kind of like the investor that you want first. If you want, again, that's the advantage that repeat founders have, which is that their previous investors, people that know them, people they worked with, they know them, right? They're friends, right? Their friends have money. Their friends have money and understand startups. That's the advantage that repeat founders have. Okay. Is Slidebean equipped to help someone with like AR, VR game development, or are you guys more focused on SaaS companies? Like I said, I've written pitch decks for. I mean, we don't write a lot of pitch decks anymore. I think that's one factor. Most of what the help we provide is through this Accelerate plan. Like I said, it's just $99 a month. So it's not a big consulting thing. It's more like, hey, show us your pitch deck. We can advise a little bit on it. And we have these tools that you can use. So it's a bit of a SaaS plus some human help. That's kind of as far as we go. We rarely get involved in writing pitch decks anymore, normally because that used to require my time, and my time has gotten scarcer over the years. So it's not a great business to sell it anymore. Okay. So how can a founder build FOMO in investors at pre-seed stage when your MVP is doing half of the target ARR? How do you get investment when you have proof of work, but the full target has not been reached? Again, those types of catch-22 situations. Agent Smith. Is it Agent Smith? Agent Hims. It's very hard to build FOMO at pre-seed because you don't have metrics, right? You don't have any metrics to show for. Again, and we established those two rounds. Pre-seed is you're raising money to build a product and launch it. That's why you raise money. At seed, you've launched a product. You're now looking to grow that product really fast. Those are two great moments to raise. Obviously, there's a lot more FOMO in seed. In pre-seed, there's less FOMO. It's more about, hey, like, do you believe in this product? Do you believe that we can develop it? FOMO gets created, I want to say, a little bit artificially by the founder hype, right? That's kind of what gets investors excited at that stage, at pre-seed. But if you're between these two, right? If you have a product that you finished but you haven't launched, you're ready to launch it but you have money to do it, or maybe you launched it but you don't have enough revenue yet, then that's a rough time to raise money. I would argue that it's even better to try to get yourself out of that catch-22, right out of that death valley, and just try to push for a little bit more revenue. Maybe use accelerator money to push for a little bit more revenue and get to seed, right? So you're in a great position to raise. Because if you've just launched your product and you're making $2,000 a month, you're in a bad position to raise. And you're not going to get great valuations. You're not going to get a lot of investor response. And part of that is just the fact that, you're saying 20K ARR. So, you have a 12th of the revenue. So you're making $1,000 a month, basically, 1,500. You don't have the metrics for seed. It's just what it is. You don't have the metrics. So, ask yourself, do you have the money to get to seed? And if you do, then try. If you don't have the money to get to seed and you need to raise money now, you can't present this as a seed company yet because you're not there yet. Seed investors are going to look down on you because you haven't reached the milestone of seed. So you have to either present it as a pre-seed round to those types of investors that write smaller checks, or go with an accelerator maybe that tends to invest in companies in this stage. So that's now you're in this situation, and you have to find a way to get crawl yourself out of it. But for everybody else, right, that's the situation where you don't want to be in. You don't want to be stuck between rounds because it's a rough place to be in to try and raise money. Again, speaking from experience, this happened to us. We got stuck between seed and Series A. We didn't have the revenue, we didn't have the metrics, and we weren't able to raise money. We had to lay off a bunch of people, and we were lucky that we were able to turn the company profitable in that time and survive, but we lost all of that momentum that we had with the rounds of funding. So there's no, yeah. So like, don't make my mistake for everybody else. Just try not to fall into those holes. Okay. Do you, sorry, Matthew, do you put the plan for Series A funding into your seed round deck? And so show the investors how they may get diluted. No, I don't think you have to forecast what your Series A valuation is going to be, because nobody knows, right? That depends on a lot of factors, depends on the market, depends on how much you actually accomplish. So no, it's not about, investors know that they're going to get diluted. That's just the game that they're playing. So nobody needs to see your forecast on it, because it's probably going to be off. They do need to see that the money that you're raising now in seed, Matthew, is enough to get to Series A, plus a few months of cushion, obviously, plus enough time to raise the round. Remember, the rounds take 6 months to raise, so you want to not only get to the metrics that you need, but also like have that cushion to actually be able to close and deliver on that round. Any opinions on Gamma's recent 2.1 billion valuation? I see them having a potential partnership with Slidebean. That's a good question. Yeah, like Gamma came out as I think I can do a whole spiel. I've been in this presentation space for too long. Yeah, great for Gamma. I think that one thing that they did right is that they moved really quickly. I think they had a good money in the bank, a good oxygen tank at the right time. So early in the AI boom, they kind of leveraged it, rode that wave, and they quickly turned from presentations to a suite. I think that other companies that have just done presentations haven't done so well. We're not a unicorn. That's no secret. So just being a presentation product is not a great business, and that's just what it is. And you see, I think the biggest example of that is a company like pitch.com that raised hundreds of, I think 85 million pre-seed. Or at least before launching, and they still kind of fell short of their promise. So I think that the reason why Gamma was able to not fall into that is because they quickly moved out to become a suite, right? Same with Canva, right? It's not just one thing, but just a bunch of a suite of products. So yeah, great stuff for them. Like we're less in that space now. Like Slidebean is, we've doubled down into like this fundraising tools rather than just presentations for anybody. But yeah. Ex Arcadia, VC say think big when I pitch a franchise or a company brand. I think I scare them due to not focusing on my first product enough. My business launches 2 products a year as its business model. Yeah, I agree that a VC would not be very excited about this. Because VCs are looking for $100 million products, not for $10 million products, right? Because $10 million products are much harder to sell. And kind of going back to what I said earlier, right? How do you sell this company that makes a suite of 10 products that maybe serve different types of customers? It's hard. Who buys that? We see that a little bit with Slidebean, right? We have, a bunch of our revenue now comes from YouTube. So we're a bit of a media company, and a bunch of our revenue comes from our SaaS. We don't do a lot of services anymore, but at a time, a lot of our revenue came from services too. So, like, who buys that company? It's just like 3 things that are very different from each other, right? So, one of our, yeah, I think that's kind of what may apply in your case, which is, hey, 10 products, you need a lot of maintenance, right? You're not maintaining one product. There's no single expertise in your team. You're kind of maintaining all these 10 products. I'm not saying that's a bad business. It's a great business because it's very recession proof. One product does, if you have one competitor, you have 9 other products to make up for that. So that's great as a business. I don't know if it's great as a venture backable company, or as a company that goes public. Because think of the typical startup that you see in TechCrunch, or the typical startup that you see getting unicorn valuations. Are they building one product, or are they building 10? Right. And it's usually going to be one or two products that are very, and if they're more than one, they're usually very connected one to the other, or one sells the other, etc. So I think that's a factor. Alrighty, guys, I don't see any more questions, I think. I have to run. I have to run. So I hope this session was useful. Once again, please check the Startup Club channel. We have a bunch of content there. If you want some one-on-one time with me or my team, we have that accelerated plan for you. So feel free to sign up. And regardless, if you don't want that, there are a lot of freebies on Slidebean on the platform. Like I said, we have the investor finder, we have a financial modeling tool, we have a cap table, we have the pitch deck builder. So all that stuff, give it a shot at slidebean.com. And hope to talk to you soon. Remember the other session on budgeting a funding round, making sure that you don't run out of money between these rounds. That session is next week, if I'm not mistaken, hosted on the Startup Club channel or via Zoom. So thanks for tuning in.